Hi there. In this video, we will study the inventory costing methods such as LIFO, FIFO, and average costing method. Okay, then what are they? To introduce into a problem, I mean, to address what makes the costing of cost of goods sold difficult. As we've discussed at the previous video, let's use this hypothetical company's inventory situation, which is presented in your textbook. Okay, the setting is this company at the beginning of the year had inventory of 100. In this case, the company's name is Houston Electronics. Astro condensers. I have no idea what this is. Some kind of universal, I don't know, astro. It sounds like heavenly something. Anyway, yeah, the company had 100 condensers, which they bought at 10. All right, sounds good. And let's further assume that all of the condensers are identical to each other, meaning you cannot distinguish among different items. Like you purchase further 200 in April 15th. And again, let's assume that these 200s are identical to each other, but also they are identical to the beginning inventory items. And let's further assume that these 200s are purchased at 11. Okay, so the cost of initial inventory was 100 times 10, which is $1,000. Your total purchase as of April 15th is 200 are purchased at 11, meaning to purchase these 200s, you used up 2,200. Likewise, you purchased another layer August 24th, 300, but this time it is 12 each. So 12 times 300, which is 3,600, is the amount that you've used up to buy these 300s. Again, November 27th, you bought 400 more at 13 each. So 400 times 13 is 5,200. Okay, and again, the maintained assumption is all of them are identical to each other. Okay, you cannot distinguish these 400s that you bought at 13 from those that you bought at last year at 10. They are identical. Okay, that said, this is the year end. And again, every year end, you need to report your financial statements to the, to outside users. So you need to check your inventory. You counted your inventory contained in your warehouse and then found that 450 are left unsold. What does that mean? First of all, let's see how many were available for sale. Again, goods or units available for sale. How many were available for sale? We can say that 100 plus 200 plus 300 plus 400, 1,000 were available for sale. Okay, 1,000 meaning in total 12,000 dollar value amount of inventory were available for sale. Out of this 1,000, 450 are left. Then how much is the units that are sold out? How many units are sold out? We can say that out of 1,000 available for sale, 450s are unsold yet, meaning the units sold out are 550, right? Then I told you that they are identical to each other, right? Then, what's the cost of these units sold out? What's the cost of goods sold, right? Our question began from how much is the cost of goods sold? How much is the cost of these 550 units sold out? If we know the unit cost of it, then by multiplying the unit cost by 550, we will get the cost of goods sold, right? But do we have the unit cost for these 550? Can you say that these 550s are from this layer? No, we don't have enough. We don't have enough for 550. Only 400 we have. Then can you say 100? Not either, right? We don't have enough to explain the 550. At the beginning, we had only 100. So the unit cost cannot be 13, cannot be 10. Then what number should we use? Right? The question comes from here. Maybe a number in between, right? That is an idea, right? You may say that we shouldn't use a number in between these two, like the middle point between beginning and ending, which is like about like around 12.5. That's an idea, right? Accounting is not something like law of physics or law of, I don't know, I'm nobody when it comes to, this natural science. Again, accounting is not something like that. Accounting has been developed by business people like you and me, right? They have developed based on their practice. So I'm just saying that you can develop your own inventory costing method. What do you think? What kind of unit cost should we use for this 550? The middle point? 4.5? That's an idea. But I would say that it's unfair, as how many of what tens are out there? Only 100s. While how many 13s are out there? There are 400. Wow, much more. 4 times more than the 10s, right? So rather than finding just the exact middle point between these two beginning and ending numbers, maybe we should use so-called weighted average method. Meaning, how much is unit cost? Maybe we can use average cost, weighted average. How do you get that? You weight by number of units. You weight, right? You weight a unit cost by number of units, which is 1,000. You weight 11 by number of units available, which is multiplication between these two, right? You weight. And then sum them up. How much is it? 12,000. You divide this weighted total cost, 12,000, by the goods available for sale, which is this number divided by that, which is $12. Okay, $12 is the weighted average cost, unit cost. Okay, then we are beginning from average cost method. On the average cost method, the cost of goods sold is, again, number of units sold out times the weighted average unit cost. So cost of goods sold is becoming 60 $6,600. All right. Then, how much is your ending inventory? As we've discussed at the previous video, your ending inventory equals beginning inventory plus purchase minus cost of goods sold. But indeed, this is the same as this part, beginning inventory plus purchase is the same as, it is often called cost of goods available for sale. Again, it is often oftentimes beginning inventory plus purchase is called cost of goods available for sale. Okay. And how much is cost of goods available for sale in this case? It is beginning plus purchase, which is beginning plus all purchases. So cost of goods available for sale is already calculated as 12,000. Your ending inventory is nothing but 12,000 minus cost of goods sold, which is $5,400. Indeed, this method is one of the accepted accounting standards, one of the accepted methods by accounting standards. Again, generally accepted accounting principles, the US. Okay, this is one of the methods allowed. Then what, is there any other methods? Another method that is allowed is called first in, first out method. Often it's called FIFO. Then on the FIFO, it is said that your cost of goods sold should be, again, cost of units, goods, right? Cost of goods, cost of units sold out should count in first. Okay, cost of goods sold out should be counted from the first. Okay, again, cost of goods sold out should count first ins first. Okay, first ins are first sold out. That's what it means. Okay, then what are the first? These are the firsts, right? How many are sold out? 550s are sold out. These are the firsts sold out. Then, are there enough to explain the number of units sold out? No, not enough. Then what's our next first? When we use up this first, then our next first is them, the second layer. Then are there enough to count 550 in the first two layers, 100 and 200? No, not so much. 100, 200, summing them up 300 are not enough to explain 550. Then we should go to the next first, which is this layer. Are there enough? 100, 200, and 300. Summing them up, 600. Yes, 600s are enough to explain 550. Indeed, we don't need all of 600s. We only need 100, 200, and 250 more to explain this 550. Right? what I'm saying is we need to use all of the first layers, but it's not enough. We will use the second layers, 200 times 11, right? Are they enough? 100 and 200, which is 300? 300 is enough to explain 550? No, we need more. How many more? 250 more. They come from the next first, which is this layer, 12. Meaning on the cost of goods sold, on the FIFO method, cost of goods sold is 6,200. Ending inventory, the same as before, right? Again, cost of goods available for sale, which is 12,000, minus cost of goods sold, which is 6,200, is 5,800. The third method, another method allowed in accounting standards, is called LIFO, last in, first out. Can you guess what this means? Can you guess how to calculate the cost of goods sold in this method? Yes. Last-ins, what are the lasts? Last-ins. This is the last-in. Last-in is the first sold out, right? Cost of goods sold should be explained from the last layer, 400 times 13. Then are there enough in the last layer to explain 550? No, only 400. How many more do we need? 150 more. 150 should come from the next last. 150 should come from the next last. Are there enough? Yes, we have enough, 300 to cover the 150, right? So we just need to use the two last layers. That's enough to explain 550. How much is it? 7,000. Ending inventory using the same formula, right? Cost of goods available for sale, which is 12,000, minus cost of goods sold on the LIFO, which is 7,000. The result is 5,000. Okay. There is another method which is called specific method, but we don't have to. That's easy. Just you specific identification method. That's just you with an assumption that you can identify each of the items. Like each of the items have unique ID code. You can match these 550s to where these 550s come from. We don't have to discuss. There is no problem about what should be the cost of goods sold if we use specific identification method. So yeah, so we've studied 4 methods. Again, specific identification method, average cost method, FIFO, and LIFO methods. In the next video, we will have a look at the impact, the effect of your choice of these methods. Right then, see you there.